Funding a whole life insurance policy with a lump sum. Does it make sense? Can I do it? We're going to touch on some of those questions here. So when it comes to funding a high cash value life insurance policy, we'll often get the question, hey Steve, I've got a lump sum of money. I want to get it into a policy, but if I just give you all of the money up front today and just plow it into the policy, that should produce me more money, correct? Because if an insurance company is paying a dividend, say of 6%, would getting all that money into the policy up front produce me more interest, a higher return, as opposed to spreading it out over a number of years? If it was just a basic mutual fund that was producing 5% indefinitely, I'd want to put it all in there at once. However, when it comes to a life insurance policy, it's much different. A couple of reasons why. So firstly, can I add a lump sum? So if you've got a lump sum of $300,000, can I make that payment into a policy right off the bat? The answer is yes. Does it make sense? Not really. Here's the reason why. So, two main components. I've got my base premium and then I have my MEC limit. When it comes to the base premium, that primarily purchases me a whole life insurance death benefit. The company typically overcharges me for the death benefit in the first year, sometimes first and second year, depends on the product and company. But money can go there or PUAs when I actually cash flow a policy. Let's assume we have a company here that allows me to set my base premium at 10% of my total desired payment. So if I want to pay in 100 grand, that means my minimum premium could be 10,000. Not to say all companies allow this, some go lower, some go higher, depends on the company. Then I've got my MEC limit. So another name for this is my 7-pay test or 7-pay premium test. This specifically has to do with the first 7 years of a life insurance policy. You know, my MEC limit has a direct relationship to my age and death benefit with a life insurance policy. That's, call it the measuring stick that the IRS uses to determine if a life insurance policy will be viewed as life insurance in their eyes or a pure taxable investment. Okay, so I want to set the MEC limit at whatever my payment is. Meaning, again, if I want to pay in 100 grand, let's assume we want to set a MEC limit at 100K. If I set it higher, let's say I put it at 110K, what that means is I've got a higher death benefit, which comes at an added cost in one shape or form, which will then therefore create more drag on the policy. So those are things I want to weigh out when I look at the options, when I start to analyze a policy. Okay, so I've got my MEC limit, has a direct relationship to the age and death benefit, and really wherever I set that MEC limit, it is going to be set in stone for the first 7 years if the death benefit remains level or increases. Here's the thing. If I reduce the insurance expenses, which would ultimately lower the death benefit within the first 7 years, I'll trigger a MEC. Often you'll hear the expression in respect to a term rider, we want to cut the term rider after year 7. The reason why is for the first 7 years is where the IRS is looking very closely at the policy. After year 7, I can reduce that and not see a MEC warning show up on the policy. That's the reason why. So, my MEC limit. If I want to pay in what we used as the example, 300K. So I've got a lump sum of $300,000. That means I would need to do what? Set my MEC limit at $300,000. My base premium, if it's 10%, what does that mean? I need to set my base premium at $30,000. Here's the thing. So here's the key on this. If I make a one-time lump sum payment, can I do it? The answer is yes. Does it make sense? Usually no. Here's why. So 300K year 1, let's do this. Let's go 5 here. Year 1, I pay in 300K. Fully funded the policy, 10x to the base premium, cash rich right off the bat. Year 2 rolls around. that $30,000 base premium is still due. If I lower it, if I reduce the term rider, if I eliminate the premium through reduced paid up, if I make any moves like that, the death benefit will drop, resulting in a MEC, a taxable event. Obviously, I don't want this. So what I'm going to force here is that premium is still going to be due. And if I'm not paying it, so we're writing in here, red in here, what this represents is the premium still due. And the policyholder, if you're purchasing this, you said, I've got a lump sum, I want to add that into the policy. Yeah, I might want the option to keep adding to it, but I do not want to be committed to more premiums. One lump sum, that's it. What's the most efficient way to get it in? This would not be it, because years I'm not paying it, and this would occur through year 7. That would continue to occur, the drag that is on the policy. And then after year 7, I could cut it off. And then the policy would begin to pick up again. We're going to look at an example in our next video. Point being is what I'll look at here is really the drag on a policy. If I make a one-time lump sum payment, I am relying on the policy to pay for the premiums through the dividends and interest of the policy. And typically after 1 year, there's not that much going on in the policy, not nearly enough to cover that minimum base premium. So can I fund with a lump sum? Yes. Does it make sense to make it a one-time payment? No. What you will find, the answer to how to fund the lump sum of money efficiently is to spread it out over a number of years. Depending on our age, that might be 2 years, might be 5 years. We're going to look at some examples of older individuals in our next couple of videos. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.